That's right.
You're right.
There's someone at the door.
All right. So let's see what we have here for email questions.
You know what? I didn't send you a question, but I was thinking maybe a good one would be.
Well, no, you did. I couldn't get my taxes filed before April 15th deadline. Can I still get a loan if I'm self-employed?
Didn't we do that last week? Or last time? If not, then let's roll.
I don't remember that unless you were here doing one without me, which I know you've done,
Okay.
but not
So
recently.
you might be right, or maybe I sent it right in. I don't know.
Here, let's see.
Get some
No,
goodies.
you
I
were
was
here
looking
last
over.
week. No,
Rush.
it's been a while. It's been a while.
Okay.
This is a good one.
Callers, I'm sure remembers that.
Okay.
Listeners.
Okay, and then Mark, we have here, are there still some good deals in the Bay Area, or are you finding that you need to expand your geographic location? Deals.
Okay.
All right. Okay. Let's get rolling.
What do you got? You got some stuff to start out with,
hold on a
Rob?
second. Yeah, hold on, let's see.
I mean, we're good. It's not a couple minutes before.
I think you
Plus
want to use the black headphones.
Okay.
I think that's for number 3.
that's for girls.
I got a 3.5-year-old son. Yeah, he's very direct about what's girls and boys.
Otherwise, you'll keep yelling in this thing going, what's wrong? I don't understand. I'm not hearing anything.
Yeah, there are no girl headphones. There's just girl microphones.
Is that mic okay? Like that?
1, 2, 3.
Yep.
Sounds good. Okay.
So you got some nuggets
let's
there?
see here. I was going to talk about elections
Okay.
and interest rates. I have some interesting stats on that.
Okay, all right.
I got a couple of generic little things here. Let's see. Low inventory. An inside look at the homes and mortgages of famous Oscar movies. Google shuttering mortgage comparison tool. And adding up the cost of smoking. I don't know if you want to cover that. They talk about a mortgage in there. And then there's this one, Mark. So I think these two are really kind of playing to your wheelhouse when we are on the air where
What?
This Verizon just did an update, and it's really messing things up.
Oh, your phone is messed up.
Yeah.
Mortgage tag contributes to inequality. Well, yeah, I don't know. That kind of
but the old, it's like
inside look at the homes and mortgages of famous Oscar movies.
so like the movies that were Curious Case of Benjamin Button and the house that was in it.
Yeah.
And so kind of interesting stuff, but
We run out of stuff that says.
Yeah.
Sometimes I you bring stuff in and maybe you save it for another show.
branches off.
Yeah. Because I've got a couple of.
And this one, maybe we could start with this. 91.5% of homes in the U.S. have positive equity.
How much?
91.5% of homes in the U.S. have positive equity.
Does that include condos? I was talking to somebody in Sacramento, and they still haven't.
You know what? It probably does, although you're right that condos are a drag on whatever that number is. And I actually have an interesting story about that, about a condo in Richmond. So I don't know.
Okay.
Maybe we can cover
We
it.
got some good stuff.
Yeah,
I just think of some good stuff to talk to.
I'm happy to lead with this one, the election stuff, mortgage
Yeah,
rates. And
let's do
okay.
that. Yeah.
Right.
Let me mute my phone. Hold on. Okay.
That's better to have.
Yep. It's all work. You guys ready?
Yep.
All right, here we go. Welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hunt of Pacific Private Money, one of California's fastest-growing mortgage investment firms, and Rob Spinoza of RPM Mortgage. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during this show. And the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located about 1 hour northeast of San Francisco. Those vacations are free. Their only request, a $100 cleaning fee to cover the housekeeping expenses. Today's trivia theme is just general trivia. All right?
That narrows it down.
Yeah. We'll open there. Sure.
I failed miserably last week on this one, so we'll see how this week goes.
Well, your chances have expanded greatly.
That's right. And now you don't have to go back to college. And later on in the show, we're hoping to hear from Gary Schlossberg, who is Wells Fargo's chief economist. So if you've seen the show and you hear the phone ring, Don't answer it. It's not your phone. It's
Okay.
our phone.
Looking
Okay.
forward to that one. That'll be great.
That'd
I've got
be
some
great,
good
yeah.
questions for him.
Okay, good. Rob, you got some good stuff for us.
You know what? He'd probably be interested in this stuff. I did a little bit of research myself because I've been getting a lot of, just in the course of a lot of conversations, been talking with a lot of borrowers who are asking, hey, what do you think is going to happen in November when we elect a new president? What happens if, God forbid, Donald Trump gets elected? I'm kidding. What happens if Donald Trump gets elected? What happens if a Democrat gets elected? So what I did, I went back through Freddie Mac's 40-year history of tracking 30-year fixed-rate mortgages. Okay, all going back to 1971.
Okay.
And this is not scientific. I'm not an economist. I'm therefore just as fallible as anybody when it comes to this stuff. But I went back through all the elections, and during that time there were 11 elections. Okay, in only 10 of them did rates fluctuate from January of the election year through December. So the election had no effect in 1972, I think, when Nixon.
So 10 of the 11 you're saying had no effect?
No, 10 of the 11 had a change.
Oh, had a slight change.
But one year didn't have any change at all. So for those of you who are out there thinking, hey, look, what's going to, we're going to see a dramatic change. Right. Okay, so you got that in your corner. Now, of the remaining years, there were 6 years where, there were 6 years where a Democrat was elected and there were 6 years where rates went lower and 4 years where rates went higher. Okay, of 3 of the 4 years where rates went higher were Republican victories, and 4 of the 6 that went lower were Democrat victories. Okay, so again,
Wow.
Infer from that what you will. The biggest change in any single election year from January through December was 1.91%, and that was, you want to take a guess? What?
1980.
Yeah, you're right.
Because that's a large percentage.
That's
not when it's big, but 20%.
Reagan defeats Carter, so he's taking over in the early 80s. 1.91% change from start to finish in that year. But
Did it go up or down?
It went up.
Oh.
Yeah. So it
was a hangover left over from the Carter administration.
But wait, so that's actually a great question, Mark, because
What was
in January, the interest rates, the prevailing rates were 12.88%, and they went to 14.79. Okay? And then over all of those years, over 40 years of tracking rates, and election years in particular, the average difference in those years was 0.47%. So less than 0.5% start to finish in any election year. I think that's really encouraging news because we started this year at almost historic lows once again.
So is that why they call them Democrats and Republicans? It's all the same, doesn't matter who
Well,
you're
I think that's really, the truth of it is that
yeah.
the media likes to play up. Well, if Hillary gets elected,
Right.
Interest rates are likely to go up, and if a Republican gets elected, they're likely to go down. It doesn't work that way. In fact, interest rates don't behave in accordance with consumer sentiment or political parties. There are so many variables that go into
Right.
long-term rates, and since mortgage rates are not really based on what the prime is doing and what the Fed is doing in moving short-term rates, it's based on the long-term rate
Right.
projections,
Right.
which, as we move more and more into global markets, so much of it is impacted by what's happening in China or Russia.
You hit the nail on the head because as I was going through this study, as I was kind of conducting it, looking at all the numbers, I'm thinking to myself, well, how did the global economy play into things in 1972 versus 2016?
Oh, no,
and
it's
so
Right.
different, right? Exactly.
because global wasn't really global back then.
Right. So I think consumers, especially those looking to enter the housing market or possibly refinancing their home loans, whatever the case may be, control the things you control, and this is not one of them. So if you're waiting to make a decision based on what the outcome of the election, know that you've got a lot that doesn't really fall into anything that you would have any control of or could predict reliably. Make an educated and informed decision.
And interestingly, among last week's headlines, among the blog posts I was reading, is that mortgage rates are at a 3-year low.
Yeah, we're seeing another little bit of a retracement, which is really, and we're going into the end of April, where the Federal Reserve, another open market committee meeting at the end of the month. A lot of speculation as to whether or not the Fed will raise rates, and here we go again, finding ourselves right in that position we were in December, where they did raise rates, much to the expectations of the broader economy, but we saw rates move lower from there. We were on a pretty steady trend higher going into that meeting. The markets got what they expected, and lo and behold, because it was something that they didn't predict. The market responded
Well, is
favorably.
it a supply and demand thing, or is it the recession on the horizon? What do you think?
Tough to say. I think
I'll
that
ask Gary that.
well, we could ask Gary that. It would be a great question for him. But I also think that it's one of those things where it's the enemy you know versus the enemy you don't know. Now the Fed raises rates, 0.25%, and okay, so that's what happened. Now the market can stop speculating as to how many rate increases there might be or what they might look like. They've been broadcast some signal and can make a determination from there. That's what I think it was.
So when I read that headline that mortgage rates were at a 3-year low this past week, it had me remember an article I brought to the Best of Investing in December, in which 25 economists were interviewed about their prediction on interest rates, and 24 of them said they were going to go up, and one said it was going to go down. And of course, you look at the one guy and you think, what an idiot. There's always some contrarian.
Yeah.
And so the point is that nobody
Right.
expected that in spring of 2016, mortgage rates would hit a not only a low, but
Right.
a 3-year low. And
Well,
that's
Mark,
just-
and you touched on it with what you said there too earlier. We're in a little bit of a retracement in terms of interest rates. Everybody thought they would go higher, and it's important for folks to remember that we are at very, very conducive rates to the housing market in general. And if you're in that
it's
situation,
a gift to the housing
Yeah,
market
exactly.
this spring. I mean, what a
don't
great
take it
time!
for granted.
Yeah, what a great time to be in the market for real estate right now. And and that interest rates being low as they are now, it also dovetails to the question that I get all the time is, where do you think the real estate market's heading? Do you think we're at the peak? Do you think we're starting to see a correction already? I mean, nobody really knows that, but there are indicators out there that maybe we have reached a peak. But then again, real estate, unless you're making it for an investment decision, if you're looking to buy a home, there's really no better time than to be entering into that transaction right now based on the cost of money.
Well, just because you hit a peak doesn't necessarily mean it's going to quickly hit a valley. It could
Right.
be just maybe
Well, nothing
Good
happens
point.
quickly
Good point.
in
Yeah.
real estate.
Right.
I mean, let's not forget the peak of the market was generally believed to be around 2007, and the bottom of the market is generally believed to be around 2010, 2011.
Well,
so that's a 3-year period.
It's a 3-year period, and it seemed like it was happening overnight, but it did take
did,
a long time
yeah.
to play out. And the other thing that I think people are inclined to do, it's not their fault, but they think peak, and then they think valley, like
Yeah,
we just
exactly.
discussed, and
Right.
they think
So it's a crash.
same
Yeah,
circumstances
happens
all
overnight.
over again, but you don't have the same circumstances creating the peak. In this environment, you don't have a credit bubble anymore. Everybody that goes into the housing
That's
market
true.
now needs to qualify for
Yeah.
their loan. There's a lot of all cash investment. I think Marin County, where we're broadcasting from, their 36.2% of all transactions in February of this year were all cash. Very, very different landscape than we were in 2006, where it was highly leveraged, a lot of risky loan
Yeah.
programs. Those circumstances don't exist anymore.
All right, guys, we're going to cut to our first commercial break. Before we do, we want to make a last mention here for Afterguard's 3-hour San Francisco Bay sailing. Only take a maximum of 6 passengers, which means that their boats are not crowded, and go from either Treasure Island or Central Basin, Oakland. All kinds of weekday and weekend sailing set sail, including sparkling beverages and the light snacks. Call Afterguard at 510-535-1954 or email them at info@afterguard.net or just go to their website, www.afterguard.net. All right, so here is our first trivia question. We're talking general trivia. The share price of what social network more than doubled in value the first day it was listed on the New York Stock Exchange in 2011? All right? The first caller with the correct answer wins a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer that question. The share price of what social network more than doubled in value the first day it was listed on the New York Stock Exchange? Stay with us. You're listening to The Best of Investing. We'll be right back.
2011.
Yeah, that's the key thing here.
So because we were talking about how the stock market went, or how the housing bubble, was still bad in 2011. Let's see. Got too much going on,
Yeah.
You know how that is. I do.
You have too many thoughts competing for
The
space in your brain.
And then there's the wife. Can't forget about her.
That's right. So when he calls, hopefully it's him on the line and not his secretary putting him through. But
Yeah, I think it'll be him because he called me before.
Oh, did he?
Yeah.
Okay, so good. So he'll call in, and then you might as well let him know. Hey, perfect timing. We're live, or we're recording. I guess I don't know if you want to say we're recording.
Yeah, so we're
Just roll with it.
Just roll.
He knows we're gonna.
He knows we're recording today and later on Saturday. He's a nice guy. Do you remember we had him on 5 years ago? He was one of our first guests. So it was really a lot
What's
different.
his name again?
Gary Schlossberg from Wells Fargo. I'm actually kind of surprised they let him come on. But
Yeah.
yeah, especially Steve Cobb. So which way are interest rates going? What do we, give us all the good stuff. So Mark, we'll come back in with you.
Sure.
Yeah. Make a quick mention for upwards on the vineyard too. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Tomp and Rob Spinoza. We kept to the first commercial break. This is the question we asked. The share price of what social network more than doubled in value the first day it was listed on the New York Stock Exchange in 2011?
You got a guess?
Twitter. Nope.
Facebook.
No.
MySpace.
No, MySpace.
LinkedIn.
No, LinkedIn. Yeah, it was LinkedIn.
Oh.
I'll take a couple of guesses.
It's hard to remember when they do their IPOs.
Exactly.
Yeah, that is
All I know is they were all basically overpriced and bubbled out.
Yeah. I don't know what LinkedIn is now, but Mark, before we get into you, I want to make a quick mention here for the Auberge on the Vineyard, which is located in Cloverdale, situated at the confluence of three of California's greatest wine growing regions. Auberge on the Vineyard is the perfect starting point to discover the charms of Sonoma and Mendocino counties. Check them out at, this is a long one, www.sonomabedbreakfastinwinecountry.com. If you can't remember that, just call 707-894-5956.
What's the phone number again?
It is 707-894-5956. And if you take a look at it, it looks like a very relaxing bed and breakfast to enjoy the wine country.
Yeah, after you get done typing in that URL, you get a break.
What do you got for us?
You have a question for me, don't you?
We do. We got an email for you. It says here, are there still some good deals in the Bay Area, or are you finding that you need to expand your geographic location for deals?
So, interesting question, because it presumes that we're specifically targeting certain areas to make loans, and really people in the private lending industry, like Pacific Private Money and like others who are resources for non-bank alternative financing, generally short-term loans, fast funding type loans. We build our business based on creating an influx of leads, basically applications, people looking for money, calling us, emailing us, and describing their situation. And the key to having a successful company like I believe we do at Pacific Private Money is doing basically years of marketing and exposure and advertising and working with realtors and mortgage professionals and letting them know that we have, there is an alternative to bank financing when bank financing fails, and it fails for many reasons, or there just is a timing issue and you need fast funding, you need to close quickly. Glitches happen. It's not a large percentage of real estate transactions that glitch, but it does happen, and when it does, we're a plan B when plan A fails. And so yes, we have our preferred areas to lend, but we're not. I don't believe we're geographically concentrated, other than saying we tend to lend in Northern California. Most of our loans are in the Bay Area. And I do appreciate, as a business owner and as a lender, geographical diversification. So, in other words, even though we're not as familiar with Southern California markets as we are Northern California markets, we have access to professionals and consultants who can help us evaluate a mortgage application in Southern California. And we have investors who live in Southern California, so we can actually present those options to them, and they can decide if they like that particular situation or scenario. And so we do make loans all over California. Now, we do restrict ourselves to California generally because this is where we're licensed.
Right.
And so most states have very specific licensing requirements for making loans. But the beauty of the marketing that we've done at Pacific Private Money over the last 8 years is that our phone rings a lot. We get many inquiries every day from the internet, from our referral sources, via email, via phones, and it gives us the opportunity to be very selective. And that's important in my industry because we don't want to make a bad loan. And if you don't have a lot of loan inquiries, then you're trying to figure out how to make what would normally be a loan that you wouldn't want to fund. How do you make it?
Right.
How do you make? How do you dress up a pig, so to
Yeah.
speak? Or put lipstick on a pig, as some people say. So we have the benefit of being able to say no more than we say yes, and by our count, virtually 9 out of 10 loans fail. Loan applications or requests fail to make the first cut. And that happens for a lot of reasons. Maybe they're asking for 100% financing.
Right.
Maybe we don't like the area. I just turned down a loan request for a commercial property in the East Bay just because when I took a first cut of the street view, I kind of cringed.
You
It
know,
was a place I would want to drive
right.
even during the middle of the day, let alone. So I just,
Very boots on the ground.
Right,
kind of
we
thing.
have
I mean, that's important.
Private lending, hard money lending is very subjective. It's actually like lending used to be 50
Right.
years ago.
That's just what I was thinking.
We're not, ones and zeros and numbers lending like
Fannie Mae,
banks,
Freddie Mac, yeah.
right? And conventional loans. We're very much subjective. We look at the story, we look at the borrower, we look at the property, we make a decision based on a set of variables. And because we're working with other people's money, we take the position that we have every right to just say no. Now we're still bound by non-discriminatory regulations and practices. So, and I don't believe we discriminate against
Race, creed. all
right,
that,
right,
all
the
that.
standard stuff. But again, we can't force our investors to like a loan situation. But we
Right.
think we know the types of situations that they do like, and that's what we look for.
Now, do you see enough both investors and inquiries to be able to do something like this? Let's say you had a property, we're here in the Bay Area. Let's say it's a little bit further afield. It's either north or it's further east or something like that. Property is a little bit out of your field of expertise, but you have an investor in that area. Will you?
Yeah, absolutely. So what we will do is we make no promises. We say, look, Mr. Barber, we're on a best efforts basis here
Right.
because it's a little bit outside our range. But it just so happens I have like 5 investors who live in Reading. So if it's a Reading request or Shasta or that area.
Right.
Same thing with further like when we get in the foothills or Tahoe area, Truckee, for example. I've got investors who live up there and they like that. Just as I said earlier, in Southern California, we've probably got 30 or 40
Well,
names
they know
note
the area.
investors.
Right.
Right, exactly. So when it comes to our fund now, on the other hand, we're since we are in control of the fund capital when we're making a lending decision, we generally prefer that those loans satisfy a number of criteria. One of them, we prefer them to be local, and we prefer them to be short term with a really super reliable, verifiable exit strategy, because that's the type of loans we look for in our fund. People that are looking to buy a home,
Right.
close quickly, pay us off conventionally within a year. That's typical of the loans that are in our fund portfolio.
And you mentioned the fund. We've talked about the fund in the past. What's the current yield on the fund?
I literally before the show, I saw the email come in for the March accounting, and I didn't get a chance to look at it, but I'm pretty confident we would hit our minimum 8% mark because we've never failed to do that in 35 prior month accounting periods. So, and that's an annualized rate. So it's somewhere usually between 0.67 and 0.70 is generally for the month where it hits. And when you multiply it by 12, you get a little bit of 8% plus.
Yeah, I can get that yield in the bank. Oh, if I tie up the 1 month for like 6 years, they'll give me 0.7%.
700 year CD.
Yeah, so you're lucky to see a 0.7% yield
For a year.
For a year.
Right.
let alone for the month. So again, that's what Edward's talking about is the Pacific Money Fund. It's a mortgage pool fund that we run at Pacific Private Money, and past results are not a promise of future results, but we designed the fund to produce a yield around 8%, in the low 8% range, based on the loans we make right around between 9 and 10% consistently. I don't see demand for the product, the loan product that we produce. I don't see demand for that shrinking. It's just with Dodd-Frank and qualified mortgages and all the new lending restrictions that make it harder for people to qualify, we're seeing it's a whole new world in private lending.
Well, I think they want to. They don't want to. Let's put it this way: they have a very long memory. They don't want to go back in time and go, let's repeat what we made mistakes in 2007.
Well, that's just it. Dodd-Frank's the law of the land. I don't see it being repealed,
Right.
And so I see that smarter lending practices are in order for banks and mortgage bankers and other financial institutions. So there will always be a need, I believe, for alternative financing options.
I agree with that, and I want to just add one piece that we've seen recently. We do a lot of loans for self-employed individuals, and we're strictly residential and conforming and jumbo and that kind of stuff. But the agencies, Fannie Mae, have made the qualifications for partners incredibly, the test for the qualification on a partner, a lot higher than it used to be. What they're requiring now, you guys know, on K-1 forms, they're requiring that the income from a partnership is distributed, actually, whereas before, if it was ordinary income, we would count it. So these are the kind of things that would take an investor out of a conventional loan and put them into private money quickly, because a lot of times the way their K-1s work is the way they've always worked, and then when they go to get a loan this time, they find that it's different.
So
nothing else has changed.
So the banks used to count just the ordinary income, not what was distributed.
Correct.
That's
Correct.
silly. I mean, because especially if you're a limited partner,
Right.
you don't control how much money gets sent to you.
Right.
So the way the regulations are now is very, very smart.
So for more information about a private money loan, if you're looking for fast financing options, or if you're an investor and you're looking to maybe spice up the yield in your investment portfolio, and you want more information about how a mortgage pool fund might be an avenue for you to invest, please give us a call at Pacific Private Money. That's 415-883-2150, or of course just go to our website, pacificprivatemoney.com.
Great. Okay, we're going to cut to another break. When we come back, we're going to ask Rob a question that the email came in for him regarding couldn't file tax return on time.
Okay.
Self-employed, what do you do?
Yeah.
All right, before we do, I want to make a quick mention here. If you guys have heard of Beach Blanket Babylon?
Yeah.
Okay. Have you ever been?
Nope.
Okay. You know what's funny? I hadn't been in like 30 years. I went on the website, and it is, you should see the pictures, because they're doing a spiff on the election. You know,
Okay.
Donald Trump's got this hair up.
Spiff or a spoof?
A spoof, I guess. That's what it is. So, for
I'll
those of
take
you,
a spiff for that spoof.
I mean, it seems like everyone's heard of Beach Blanket Babylon. Okay.
Yeah.
They're just very, very funny. A lot of teasing going on. A lot of San Francisco stuff. Great costumes. Check them out. Beach Blanket Babylon.
Cool.
And I definitely have to go with it before the election. Because you got to. Otherwise, it'll probably be over by then.
Sounds great.
Okay, so here's our second trivia question here. In computer language, what name is given to half a byte? All right, that's the question. Call 888-912-1190. Be the first caller with the correct answer, and you're going to win a free 3-day, 2-night stay at the Lighthouse Resort. In computer language, what name is given to half a byte? Stay with us at the Best of Investing. We'll be right back. All right.
Looks like we're going to get to the third segment probably right before, so we may be able to wrap up the third segment and wait for him to call.
That's what I'm thinking.
That would be good.
Yeah.
So we might be able to keep those for the next one. Looks like we
That's fine. Yeah, I'm always trying to bring a little bit more than we need.
No, you got to. I know I do too. I've got a couple of.
So those things branch off too. It's
They
like
do.
sometimes.
Did you guys see the game last night?
Of course, the universe is watching. That was just too fun.
Yeah, but that really was.
Stephen Curry was just on fire.
Can you imagine? He probably would, if they didn't take him out of fourth quarters, he probably would have 500 3-pointers. Really? Okay. Get this bad boy in here. Here we go. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hunt and Rob Spinoza. Here was our second trivia question. In computer language, what name is given to half a byte?
Isn't it a bit?
No.
Not a bit?
Oh no, that's what I was going
It's
to
called a nibble.
Come on.
I'm not a computer, the language guy, but that's what I've been told. It's called a nibble. Half bite's a nibble.
Hold on. Let me
sense.
adjust the tape on my glasses.
Yeah.
How would I know that?
Very, very bad man. Very, very bad man. Okay. Oh, good thing we're not on radio.
We're not
You
in a
can't
bar
see
with the real
what's going
drinks.
on. Okay. So, yeah, really. Rob, question comes in from a listener. It says, I couldn't file my tax returns before the April 15th deadline. Can I still get a loan if I'm self-employed? That's a good question.
It is a good question. So we have to kind of defer to the IRS here. So let's talk
Let's
about
call them
it.
on the phone.
Yeah, no, I don't want to call them. But,
No, they're not helping.
okay. So the thing is, if you have not filed your tax returns and you've crossed the April 15th threshold, hopefully you filed an extension paperwork. Okay. So if you have not done that, you've got a bigger issue. But let's assume you filed your extension paperwork. We're going to ask you for a copy of your 4868, which is your extension paperwork. Where you get into trouble as a self-employed individual is if you have not filed your return for 15 yet, and you plan to use that year's income to qualify you for your loan. So a lot of people, for example, if they had a 13, a 14, and a 15, and the trend was increasing each year, we're going to be looking at it at the last 2 years. If you don't have your 15 filed and processed by the IRS, then what we have to do is we have to look at 13 and 14. Okay,
What about an estimate or?
yeah, so we're gonna want a P&L for the 15 and a year-to-date 2016 in that case. But we're self-employed individuals, so the answer is you can get a loan, but if you intend to qualify off of the higher income that you realized in 2015, then that could be problematic. You may not be able to get the advantage of that.
So even if you can show a high P&L with deposits and
Because the
everything.
P&L is not audited, so you don't know what's going to end up filed once the IRS processes the return.
So even if you show deposits backing it up.
We typically don't look there, so that's a great question, Edward, and it gets back to what Mark talked about earlier in the show. The test now for lenders is Dodd-Frank's provision of ability to repay. So when a lender makes a loan, an investor has certain guidelines, and the loan has to meet ATR, ability to repay. If you were going to use bank statements to document income, the program guidelines would need to be specific to how you would do that. And most lenders for your best price programs are not involving bank statements for the self-employed individual. Yes, they support the income produced on the returns, but the returns are still taxed. So in those cases, again, self-employed, you want to get your, if you're going to use your 15 return because it was a better year, you want to get those filed and processed as soon as you can. Obviously, you have until the 15th of October, I think that's right, 15th of October to file your extension, but it really comes down to your own scenario.
Yeah, the tax return is due by October 15th.
Right. Now, if you're not self-employed, if you've not filed your return, you have to file your extension. That has to be so that you're not delinquent or you're not late on your taxes. But if you're not self-employed, then we can use other things like W-2s. Exactly.
So Rob, I got a question for you. So I keep reading stats that come out every month that track the average number of days it takes for a conventional loan to get approved. And the last report I saw that it actually had hit 45 days, up from I guess something in the 30s a year ago. And so how were you? I know at RPM Mortgage you guys are mortgage bankers, and you're not necessarily bogged down by some of the same as banks and mortgage brokers who have to broker out to banks and others. How are you guys faring at RPM?
We're doing on purchase loans now. What we're doing in an attempt to front end everything is we're asking clients to go through the pre-approval, and then we're actually underwriting them when the pressure of their contract is off. So a lot of the work is being done before they're ever in contract. All their income, assets, credit, all the things specific to the borrower are done in advance, such that when they go into contract, we're just adding the appraisal and the contract and the specifics of the property. So that enables us on the purchase side to cut down on the timing significantly. So we're hitting purchases. Most other lenders that I've noticed in the industry also prioritize their purchase business for the obvious reason that you have a contract involved. But some of those lenders, especially the big banks, they lag dramatically with their refinances. Now, if you're in process and you're a refinance and you're saving a lot of money, you don't really care that the bank has those kind of structural issues.
Couple of extra weeks.
You want to get your loan closed regardless, and we are finding that the bank, our operations right now are running very efficiently. We're getting all of our scenarios done, purchase and refi quantify, and this is, again, like you said, the benefit of working at a dedicated mortgage bank, but all of our stuff, so long as the borrower cooperates and there are no hiccups in the process due to the property, we're still running well under those averages that you see published.
So it sounds like getting pre-qualified means something different today than it did a few years ago when you just get like a pre-qual letter, which almost could be just written just based on a telephone request and maybe a tax return or something. Sounds like you're actually going through and pre-underwriting under basically an estimated scenario.
Well, the market is demanding that right now because in the Bay Area especially, which is where we're headquartered, the demand for homes is very high, the supply is very low, and it's not unusual to encounter multiple offers and a lot of competition for desirable properties. Those buyers often run into a lot of resistance if they're not already underwritten and can offer with a very aggressive timeline. So having the pre-underwrite gives them that edge, and we made a big initiative beginning at the start of the year to do just that. So if our clients are on board, our realtors are on board, clients are approved in advance, and they're going into contract with a full head of steam, which is great to see.
Quick question for you. I was wondering why some banks may be willing to do a first and a second, but they don't want to do a second behind a different bank.
It's a good question. I think that what it comes down to is you need a lender that will do a standalone second and be in a second position. Exclusively, you got to find lenders that do that. Most prefer a simultaneous because then they understand the transaction and they're seeing it that way. So we do a lot of piggyback financing with a purchase. 10% down, 80% first mortgage, 10% second mortgage. Entirely controlled because they know the transaction. When you're adding something behind it, different story. I think lenders are a little bit more reluctant and more conservative in those respects. I don't know the exact reason why.
Seems a little odd, but
it does. Same scenario, different origination.
Because they're still underwriting, and now they're underwriting in second versus whatever.
Right.
Okay. How do people get a hold of you again?
Bio is on the Best of Investing website, so if you frequent that, all my contact information is there. I am at the Mill Valley office of RPM, right off the 101 in Mill Valley, 415-367-5959.
Great. Yeah. All right. We're going to cut to our last commercial break here, and then hopefully we'll have Gary Schlossberg, Wells Fargo Economist, call us and when we get back. Here's our third and final trivia question. Based on average income, what is the poorest nation in the Western Hemisphere? Based on the average income. All right?
Okay.
The first caller with correct answer wins a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. Stay with us. You're listening to The Best of Investing. We'll be right back. Don't go anywhere.
Western Hemisphere.
Western Hemisphere. So that's
it takes
north.
a lot out.
That's South and North America.
Yeah.
Okay. I wanted to leave a lot of minutes left.
Yeah. I'm glad we did because it'd be good.
So we're just going to wait for him to call in?
Yeah.
We probably just should. Yeah. We'll call in.
So
And
we'll have
go on.
13 minutes. Cool. That's a good way of doing it.
Yeah.
I just texted him to let him know. Call
Good.
about 10 minutes up. Yeah, it's weird. The reason I asked that question is because I want to get a second heel on.
Appetite for standalones was weird right now. I don't have a good answer for you. We're supposed to be bringing a standalone fixed rate second on board. It's supposed to be by April 1st, but we haven't seen it yet.
But you guys don't do HELOCs.
We don't do standalone HELOCs.
Yeah.
U.S. Bank, did you try that?
I went. So far, what happened was Wells Fargo had it, and then they basically said, "No,
they're not aggressive with seconds.
Not anymore." But I had it with them though.
Yeah, but still, they
won't do it. So they basically jumped out. So what I'm doing is I'm going with First Republic.
Okay.
And the lady calls me up and says, and I've known her for a while.
First Republic did HELOCs.
Yeah.
They didn't do anything.
Pretty decent rate too. But she says, because I got some good news and some bad news.
Let me have the bad news.
Yeah. She says the bad news is we won't go behind another bank.
That will be First Republic.
First Republic, yeah. First Republic will only go behind First Republic. So the good news is we'll rewrite the first. I said, well, but what rate? I go, right now I'm at fixed for 7 years at 2.875.
They're pretty aggressive though.
She said we'll match it.
Yeah.
So especially if they start off with a brand new 7-year,
Yeah.
then it's,
Now you get the
I've
amortization.
got an extra, well, I've got an extra year.
Yeah, yeah.
So I said, if
Yeah,
you
their
do that
arms
for no
are
cost,
aggressive. Be careful, they may put you in a 5-year prepay though.
well, at least I'll have to
Ask.
have them match what.
Okay,
Let
yeah,
me just give
they
you
like
everything.
prepayment penalties.
You know.
Yeah. The other HELOC lender, if that doesn't work out, remind me, but the other one is Cal Bank and Trust.
Oh, over here. No.
Right, I don't know if they write them out of there, but I have a great contact, Kyra, and I'll send you her contact info. Yeah, they have a special running right now too, so they'll go
Really?
high. Yeah, they'll
Okay.
go high loan amounts on those, and everyone I've referred to them has come back and said the experience was great.
Oh,
So
good. Okay.
yeah, so you got to fall back if
Okay.
FR doesn't come through. I'll get you her info.
Yeah, you want to just text it to me? Or?
Mhm.
So, okay, you're going down to Southern California. Is it your quarterly training thing? Okay, gotcha.
Yeah, it's all day tomorrow. It used to be on Thursdays, and then now we merged with the Friday group. So now I fly down Thursday evenings for all day Friday, then fly back Friday night.
We're in LA or
Santa Monica. So I fly to LAX, take a cab to Santa Monica, and then stay overnight.
Oh, it's not that far.
No, it's the cab ride, depending on traffic, could be anywhere from $40 to $50.
No, that's not bad.
And I could do Uber X, but I never actually signed up with Uber.
Uber X.
Well, Uber X is what can pick you up at the airport. Regular
Oh.
Uber can't.
Oh, I didn't know that.
That's what I'm told, but I don't know. And I guess it's cheaper, but I just not set up an Uber account.
I finally did. It took me a while.
Yeah.
We went. Christian and I went to spring training. We Ubered it a couple of times. Pretty
Yeah.
good.
No, it's great. It works really well. But I just, just for the convenience, you just go out of the airport, take a cab.
Can you
Hopefully it's
imagine
not-
what the cab company never saw that coming?
Oh, I
It's
know.
Boom!
And those-
Total
and they
undermine of their model.
They
Hundreds
never
of
saw it
thousands
coming.
for those licenses.
Oh,
The
the
medallions,
medallions?
million.
Yeah.
$1 million
Is it
for a
$1 million?
San Francisco medallion, or it was. Now they can't.
For one
get-
cab?
For
No.
one cab, one medallion.
My
New York,
uncle's-
New York was $2 million.
Yeah, my uncle bought and sold them in New York back in the 70s, 80s.
But how much can one cab generate?
I guess enough to make a $2 million purchase.
I mean,
Makes
if you have
sense.
20 cabs, it costs you $40 million.
I don't know how the
That'd be
medallion
something.
works.
I just remember reading about it. There was $2 million in New York and $1 million in San Francisco at the height. Now it's not. That
Yeah, I
was
can't imagine.
tremendous amount of value. Well, apparently at the time it was like a monopoly.
Yeah.
There were only so many.
Oh, all of those
Yeah.
chickens are all coming home to roost. Trust me.
My uncle, my dad's
You
cousin.
could build a better mousetrap. They never expected that to happen.
My dad's cousin was in charge of like transportation in New York back in the 60s and 70s, and then I think he got his hand caught in a cookie jar or something.
Oh, I don't believe that happened in New York.
Yeah. Jay, it was his name, Jay Turoff.
Perfect. All right.
Would that be Gary?
It is.
Hey, Gary, how are you?
Fine. How are you?
Good. I've got my co-host Mark Hunt from
Hi,
Pacific
Mark.
Private Money.
Hi, Gary.
Mark would have been with us
Yes, it was
5 years ago when you were on.
absolutely.
And you probably don't know Rob Spinoza of RPM Mortgage.
Uh-huh.
So,
Hey, Gary.
Hi. How are you?
Good.
all right, so if you're ready, we'll get this bad boy started. How's that?
Okay.
All right, sounds
Let's
good.
go.
All right, let's do it. Okay, here we go. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. Here was our third and final trivia question. Based on average income, what is the poorest nation in the Western Hemisphere?
Bolivia.
No,
Guatemala.
Haiti.
Oh, I should have thought of that.
Okay.
Yeah.
That's true.
And we do have on the phone Gary Schlossberg, who is Wells Fargo chief economist. Gary, welcome to The Best of Investing.
Thanks for having me along.
You're very welcome. And we had you on about 5 years ago, and back then the economy was
A little bit different.
in the dumpster. it's
In the
changed.
least.
It's changed just a
Right.
little. It's changed just a little bit, hasn't it?
I think so. For the better, of course, we still have the usual stresses and strains. Bay Area out in front a bit, but yeah, I think things are on certainly a more solid footing right now.
Well, Gary is economist for Wells Fargo, and you probably are charged with looking forward for a number of scenarios. Here at the Best of Investing, we do a lot of talk about real estate. And so when you were with us 5 years ago, of course, we were wondering whether we had seen the bottom of the market or if it was still ahead of us. And now we are 5 years later, and all the talk is, are we at the peak?
Yeah.
Are we at the
Yeah.
top? Are we entering possibly into a correction cycle? And obviously Wells Fargo is one of the biggest mortgage lenders out there. What do you see, and what are your concerns?
Well, a lot of it has to do with the usual housing fundamentals, as we put it, interest rates, incomes, confidence, and also the local economy. So clearly the housing market is going to vary depending on what market you're in. Here in San Francisco, we've had an advantage of very strong tailwind from the tech sector and the spillover to other parts of the market. I would say at this point, normally in an economic cycle, you start seeing inflation moving up, interest rates moving up, and affordability being squeezed a bit. But these mortgage rates have stayed down for quite some time. We don't expect to see a big move in mortgage rates until the Fed's ready to pull the trigger and start raising interest rates again later in the year. And if you look at the affordability numbers, certainly here in California, we're squeezed a little bit more than those in other parts of the country. But given the fact that mortgage rates remain fairly low, incomes are holding up pretty well. The job market is doing well. We just had a report out today showing a very healthy picture for the labor market throughout the country. When you put all those things together, I would say that while the housing market may not continue with the kind of momentum we've seen over the past several months, double-digit increases in home prices nationwide, we don't expect to see a big adjustment in housing. I think for that, you'd have to see a shock to the economy or the Federal Reserve suddenly coming in early, raising interest rates, and that having a ripple effect right through the mortgage market.
One of the things, Gary, we're always trying to do here is follow through on the various reports that come out, and of course there's lagging indicators. We follow Case-Shiller and CoreLogic that have been telling us for a couple of years now that real estate appreciation has been trending right around 10%, and so far, based on that, looking back data, that hasn't changed yet. But there's a little bit of looking forward information that's come out in the last couple of weeks, and one article in particular I shared with our listeners a couple of weeks back is an article that came out in the San Francisco Business Times recently that said a 5-year frenzy for San Francisco office space may be cooling as venture capital investments decline and tech firms slow their hiring from a breakneck pace. And the reason I find that interesting is because a lot of real estate price appreciation in the Bay Area, Silicon Valley to San Francisco in particular has been driven by wealthy tech employees and cash buyers and such. And so I'm wondering, as I see that, I wonder if that's maybe a leading indicator that we might be seeing something slow down imminently.
Certainly a straw in the wind. In fact, the Wall Street Journal just had a write-up on the San Francisco office market on Wednesday, and they pointed out some leading indicators, straws in the wind, suggesting that the real strength in the commercial real estate market might be behind us, even as the market continues to do well. But we're getting a lot of product coming on, and they did make that same point that you did, that tech may be losing a little bit of momentum. And I think that's something we really have to be sensitive to that at this point. Historically, San Francisco proper has been a fairly steady market, and I think that holds for the North Bay as well, servicing Silicon Valley, but a large, highly paid services sector dominated by banking, other financial services, legal, and the like. And over the past 20 years, we've had Silicon Valley increasingly moving up this way, and it's really made us more of a highly charged economy. And with that, there is more volatility. So while I think we'll continue to see a tailwind from the strength in tech, although the strength, as you pointed out correctly, I think is losing momentum, but equally important, the spillover of tech to other parts of the economy. I think that will continue to support housing, perhaps not at the white-hot pace that we've seen over the past couple of years. Out beyond that, though, a lot depends on the global economy. Tech does sell to the world, and that is something that has to be monitored. It is a key driver of the local economy, and by that I mean the entire Bay Area. For now, I think things will continue to move forward, but certainly that possibility that we may lose a little momentum.
Gary, do you see that the Fed really somewhat has their hands tied going into this next meeting, end of April, with just how the global market or other economies have fared versus our momentum here in the United States? That's what I kind of see as their conundrum right now. They like you said, absent inflation, concerns about global growth, and yet here, domestically, we have a strong job economy, especially here in the Bay Area. But how do you see the Fed playing out this next meeting?
Well, I think the odds are they won't move. I was just looking at a chart, one of the screens showing the probability that the market assigns to moves by the Fed,
Right.
and the June meeting has a 17% probability that they'll raise rates. Now that can change from week to week. For what it's worth, it's a better than even chance. It doesn't take place until before the December meeting at the end of the year. But the reason I think the low probability is assigned has something to do with the comments the Fed has made, concern about the fragile global economy. If nothing else, the British vote on European Union membership, that could stir things up. That referendum takes place a little more than a week after the Federal Reserve meets, and if conditions in that part of the world are unsettled, the Fed has become more globalized. They weren't always that way, but more sensitive to what's happening globally. Here in the U.S., I think we have a little more leeway. Certainly the labor market is doing well. Jobless claims came out today. They were at a 43-year low, but that really hasn't translated just yet to an increase in wage inflation, which would help propel inflation behind it. We did have some disturbing inflation numbers over the past several months in parts of that consumer price index, but the report out today for the March CPI showed things cooling a little bit, and I think at least in the short term, that gives the Fed a little more leeway to keep its powder dry. If inflation was really heating up here, conditions overseas were still fragile, the Fed would be between a rock and a hard place. But, I think things are falling into place at least for now, giving the Fed the leeway to hold things steady. As we move toward the end of the year, I think things can change.
Well, it's like, getting back to housing for just a minute, before you came on, Rob and I and Mark were talking about the fact that, it's a lot harder to get a loan nowadays than it was in 2005 with, qualifying mortgages, et cetera. And as long as you've got people employed, to me, maybe it's too simplistic, but, they have to have people employed, they have to make, decent wages, and they have to qualify for loans. Then you shouldn't see too much of a bubble.
You should have an underpinning to the mortgage market.
Yeah, exactly. Some stability. Is that kind of simple, but telling the truth?
I think to some extent it is. The double-digit price increases that you've been speaking about, Rob may want to chime in on this. He's much closer to it than I am, but it just seems to me that certainly some of it has to do with demand, and in the very strong markets, certainly, demand plays more of a role, but a lot of it has to do with a shortage of inventory. The ratio of unsold homes to sales is quite low. People just haven't really dumped their houses on the market the way they normally would. Part of that has to do with the weakness that we've been seeing in the first-time home buyer market, competition with investors buying up these homes. So we haven't seen that trade-up effect that we normally see.
Right.
But clearly the markets are tight for whatever reason, and that's giving rise to the strong increases in prices. But I think the lending availability is such that that is having something of a restraining effect on the demand side.
Well, I think part of it too is people are not willing to sell their house until they find the target property they want to buy, because they hear all these stories about being outbid and everything.
Yeah, and that's working its way all the way up through the market. Just a shortage of inventory, people not putting their homes on the market, or investors at the lower end, maybe even the middle end, buying up those properties as rental units, because rentals have been doing so well over the past several years.
I think one thing, Gary, that's really interesting is that we, sitting here in the San Francisco area talking about real estate, and you're a chief economist, so you may see this, but when I hear other agents and mortgage professionals talking about there actually being a buyer's market in certain parts of the country, it's hard to believe right now.
Yeah. I mean, look, real estate, I don't have to tell you, is at the end of the day still very much of a local market. Right. Now, the fact is, though, when you start looking at the large urban areas, that Case-Shiller number is a buildup of some 20 metro areas.
Right.
And certainly many of them, to a varying degree, are like San Francisco, some of the large urban areas. But the vast majority, I think some 14, 15 of those 20 metro areas are experiencing double-digit increases in home prices. So I agree with you. I think there are parts of the U.S. where the markets are still soft enough. The buildable land, the new supply coming on, maybe having a tempering effect. But certainly, a number of urban areas are seeing some pretty good size increases in prices.
Hey Gary, 6 months ago, all the experts were predicting a gradual increase in mortgage rates through 2016, and here we are last week with a report that mortgage rates were at a 3-year low. What do you think would need to happen, or what do you think could potentially happen that might reverse that trend to where we actually do start seeing mortgage rates gradually rising to their kind of more historical average?
Well, I think this interest rate cycle has been unusual, not unprecedented. The last major interest rate up cycle back in 2004 and 2005, actually in the first year of it, it was actually 2004 to 2007, but in the first year, we actually saw long-term rates moving a bit lower. And that's what we've been seeing this time around. This time around, I think there are two somewhat unique features, maybe three. One, the Fed is more sensitive to what's going on overseas, and the global economy is lagging. It's not being pulled along by the U.S. Recovery, partly because our recovery is more modest, partly because we're just not the big hit on the block as we were before. But certainly sensitive to that, and that's restraining the Federal Reserve in part, as we mentioned earlier. Secondly, inflation still remains low overall. There are a lot of moving parts. Inflation still could be a wild card, but with today's number, there is a kind of a relief factor. Certainly gives the Fed the cover, just from a domestic standpoint, to keep its powder dry. And then thirdly, the foreign dimension, with all these negative interest rates, some 25% of the government debt out there overseas now have negative interest rates attached. We're seeing foreign investors play a more important role in demand for our securities, and that is having a restraining effect as they move into treasuries, intermediate and longer term treasuries. That boosts the price, and of course that keeps the yield down as well. So a reversal of any one of those things, I think, could give the Fed cover to begin raising rates, or as demand dries up a bit for our securities by foreigners, that could lift things even if the Fed were to do nothing.
Great. Gary Schlossberg, thank you so much. We got to cut you off now. Unfortunately, we're going to have you back on again, okay?
Thanks, Gary.
Thanks so much for having me.
Okay. All right.
Great stuff.
Good stuff.
Yeah.
Okay. Quick thoughts for the day here. The Dow Jones Industrial Average reached a high of 380 points in August 1929, then plummeted at the start of the Great Depression. It took 25 years for it to go back up to the high of 380, and that was back in that was 1954. So it took 25 years for that. All right. And a German proverb states, "What is sport to the cat is death to the mouse." Not sure exactly what that means, but it's a proverb, so it must be good. All right, tune in next week to The Best of Investing. We're going to be giving away more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.
Awesome. Guys, I'm ducking out. So
All right,
I'm
man.
nervous about
you got to catch
just
your flight.
traffic and being late for my flight.
Okay.
Cool.
All right.
Yeah.